Right, it's just gone 9 a.m. here in London, so we'll make a start. Good morning, good afternoon, good evening. Welcome to our webinar on managing legal risk during the transition period for the phasing out of the London Interbank Offered Rate, or LIBOR as it's commonly referred to. My name is Robert Javen Fisher. I'm an of-counsel at Humphreys Kersetter LLP, a specialist dispute resolution firm based in London, England. I will be moderating today's panel discussion. LIBOR has been described by Morgan Stanley as the world's most widely used benchmark for short-term rates. Estimates vary as to its usage, but in November 2018, the Bank of England estimated that LIBOR underpinned approximately $300 trillion of contracts globally. In addition to being referenced in financial contracts such as mortgages, consumer loans, corporate debt, derivatives, and other financial instruments, it's also referenced in a whole range of contracts, which include some form of interest mechanism, be it for late payment, delay, or other purposes. That's not to mention, of course, that LIBOR is also used in many back offices for financial modelling and assessments of risk and value. Despite LIBOR's importance to the global economy, the Bank of England and the UK Financial Conduct Authority is committed to phasing out LIBOR by the end of 2021. This is because LIBOR relies on estimates from banks of their borrowing costs in markets which no longer exist, so it is not considered sufficiently robust or sustainable given its widespread use. Or to put it in other words, it no longer reflects what banks are doing in practice and instead relies on expert judgment. Now, as I'm sure we're all familiar with, in recent years, that expert judgment has faced increased scrutiny following the LIBOR manipulation scandal, which came to light in 2012. Given the LIBOR is used in so many contracts, the phasing out of LIBOR clearly gives rise to a wide range of potential risks and issues, including not just legal matters, but also commercial, conduct, and reputational matters. The main aim of this panel discussion today is to provide practical guidance to help you or your clients identify their potential exposure to issues arising from LIBOR, the options available to replace LIBOR in contracts and in back office systems, and the steps that you or your clients can or should be taking now to manage and minimize legal risk in the transition period. To make this session as useful as possible, we would of course welcome any questions that you may have, and you will know, given the ongoing pandemic, you are now probably all very familiar with Zoom webinars, but just in case you're not, there is a Q&A text box at the bottom, and please feel free to put in any questions that you have. I will be monitoring that during the discussions and will endeavour to raise any questions with the panel members as and when they arise. But if we're not able to do so, we've set aside around about 15 minutes at the end to address any outstanding questions. Of course, if you have any other comments or thoughts as we're discussing matters, please include those in the chat box, which is also at the bottom of your screen. Finally, I would add that we are recording today's webinar and will make the recording available to all attendees shortly afterwards. So turning then to today's knowledgeable and experienced panel, I'm delighted to introduce firstly Kazunori Otsuka. Otsuka-san joined Japan's Financial Services Agency in 2012 and engaged in off-site monitoring and other operations at the Banking and Securities Business Division. From 2016 to 2018, he acted as the unit chief of the Strategy Development Division, where he managed intra-governmental coordination of the financial agency's strategy and policy planning processes. More recently, he was a financial attaché at the Embassy of Japan in Egypt, where he led a team in respect of a grassroots grant assistance program, in addition to various economic and financial research activities. Currently, Otsuka-san is the second secretary of the finance section of the Embassy of Japan here in London. Welcome, Otsuka-san.
Good morning, everyone, and I'm very happy to join today's webinar. I also look forward to learn how legal issues can be overcome with help or the support of professionals. Thank you.
Thank you, Otsuka-san. In addition to Otsuka-san, we also have Hanif Verji. Hanif gained experience in structuring, valuing and selling, and indeed trading derivatives at some of the world's largest investment banks, including Lazard Brothers, JP Morgan, Crédit Agricole Indo-Suez, all having started in investment banking at Barclays de Zoete Ved in 1988. Hanif is currently a director of Vivardum, which provides expert witness and consultancy expert services for disputes arising out of the financial services sector. Hanif is also a fellow of the Academy of Experts. In his capacity as an expert, Hanif has been involved in every aspect of the LIBOR crisis since it emerged following the financial crisis of 2007, including in relation to litigation involving LIBOR manipulation, mis-selling of financial products, and miscalculation of the value of LIBOR-linked products. More recently, Hanif has advised corporations and funds who will be affected by the end of LIBOR on products such as loans, bonds, and swaps, including building models to calculate the value of LIBOR-linked contracts under various possible outcomes. Hanif has published a number of papers on the issues associated with LIBOR transition, which we'll also circulate after today's webinar. And last, but by no means least, I'd like to introduce my colleague, Toby Starr. Toby studied law at Cambridge University before embarking on his legal career at Linklaters here in London, and is now a partner at Humphreys Kerstetter, which, as I said before, is a specialist dispute resolution firm based in London. Toby is a litigation and arbitration solicitor advocate of over 25 years experience, with appearances in both the English Commercial Court as well as international arbitration. Toby's dispute resolution work focuses on complex financial and commercial contracts and includes reviewing, advising on, and litigating over capital markets and banking contracts, including loan and derivative instruments using LIBOR. Toby sees his role as providing clear legal advice and strategic guidance, negotiating hard in his client's interests to avoid litigation, but preparing the ground early to plan for litigation in case that is necessary. So that's our panel today. Before embarking on the discussions, there was a poll that we wanted to raise with you all, which I'm going to launch now. If I can give you 30 seconds or so to respond, and then we'll have a look at the responses. Got a couple of stragglers, but we're almost there. I think I'll end the polling there. Thank you all. So sharing the results, it's an interesting mix. If we take out of the equation do not know, not applicable, it seems that most people on the webinar today are in the period where they've identified issues, but they've not yet taken steps to action them. So hopefully today might help those people identify any further issues or spur them on to action if they think that they need to do so now. So perhaps let's kick off with a bit of background on LIBOR and what the options are available once LIBOR is phased out. And Hanif, perhaps I can come to you on that point.
Thank you very much, Rob. Good morning, everyone. What I'm going to do is try and share my screen with you. Let's see if this works. There we are. I'm hoping everyone can see the screen now. The end of LIBOR. Rob has given us a brief background as to why LIBOR is stopping. The real question now is, what will replace LIBOR and how will it work? So what I'll speak very briefly about today, obviously it's a very large subject and we have limited time, but what I will speak about are the LIBOR's replacements, TONA for the Japanese yen, SONIA for sterling, SOFR for dollars, SARON for Swiss francs, etc. And the differences between LIBOR and the risk-free rates that cause us problems. I'll speak a little bit about the fallback provisions. All contracts have provisions in them that allow for the contract to function should LIBOR disappear. But each of those has issues, and of course some contracts in fact don't have any provisions at all. So what happens to those and what value can be attributed to these fallbacks? And finally, I'll try and talk a little bit about the relevance of all of this to variable rate loans, swaps, and even fixed rate loans, which many people ignore. So to start off, you'll all know this, but it's important to highlight it, that LIBOR is a forward-looking rate. Now, what we mean by this is that for any interest period, we know how much interest will be paid at the end of the period. We know that at the beginning of the period. Therefore, it's forward-looking. I'll give an example on the slide here. Take 3-month LIBOR on the 19th of August 2019. Assume it's 5% and assume the loan is £10 million. Well, on the 19th of August, we know we'll have to pay £126,000 on the 19th of November. This is really important because LIBOR is a forward-looking rate, and the replacement, SONIA in the case of sterling, is a backward-looking rate. And this distinction between forward-looking and backward-looking is extremely critical for all sorts of contracts, but particularly what are known as tough legacy contracts. So how do the replacements known as risk-free rates, how do they work? Here's another example of the same £10 million loan, but functioning under SONIA. Let's say SONIA is published to be 5% on the 19th of August. The critical point is that SONIA and TONA and SOFR are overnight rates only. They're not term rates. So 5% from the 19th of August will take you to the 20th of August. And we can calculate the interest at £1,370 over that one day. But we won't know what the interest is on the 21st of August until the new SONIA is published on the 20th of August. So you can see that we need to know what SONIA is every day between 19th of August and the 20th of November before we can calculate the total amount of interest that needs to be paid. And because we can only know the total interest on the 20th of November, i.e. at the end of the 3-month period, it's called a backward-looking rate. But look, there are other really important differences as well. I'm hoping you can see the chart at the bottom of slide 5. The green line is SONIA. The dark blue line is 3-month LIBOR, sterling LIBOR, and the light blue line is 6-month LIBOR. Now, there are a number of observations you should make. Some I'll talk about in more detail, others I won't at this moment. The first thing to notice is that there's a difference between LIBOR and SONIA. LIBOR is higher than SONIA. The second thing to note is that the difference isn't constant. It varies with time. One just needs to look at here, there's the gap here between 3-month LIBOR and SONIA of about 0.5% on the 2nd of January 2012, and it narrows considerably when you get to 2014 and 2015. The third thing to notice is that that gap between LIBOR and SONIA is different for different maturities of LIBOR. So 3-month LIBOR minus SONIA is different to 6-month LIBOR minus SONIA. And the final thing I'd like you to notice, and I won't talk more about this, are these little spikes on the SONIA chart. Can you see these little spikes? Now they occur because of technicalities in the way that SONIA is calculated. For sterling, these spikes are relatively small and we aren't terribly worried about it. But when you get a bit of time, take a look at a similar graph for SOFR and you'll see extremely large spikes, particularly the large spike that occurred in October last year. Take a look at that chart, and those spikes in dollars contracts will cause enormous problems, and it's an area of active discussion at this moment. So how will contracts be changed? Well, imagine a loan agreement. You have LIBOR plus a margin. We now need to replace LIBOR plus the loan margin to SONIA plus the loan margin, but plus something I call an extra spread. Others call it a credit spread. And this is to try and equalize the difference between LIBOR and SONIA. Now, as we saw in the previous chart, that difference isn't constant. It varies over time. So some form of averaging process needs to be taken. The difficulty is that an averaging process needs to be done over a period of time. And so that extra spread, the value of it, changes according to the time you take over the averaging process. Now, the swaps market is opting for 5 years. I suspect all of the other markets will also go for 5 years to be consistent. But if you were to choose 10 years, a longer period, that extra spread would be a different number. It might be higher, it might be lower. And so either the lender or the borrower will benefit. So the implementation of the extra spread is going to be a source of debate and perhaps, if not resolved, dispute. But we can argue about this extra spread as it relates to each currency and each type of contract. There are some contracts that simply cannot be converted to a backward-looking rate like the SONIA or TONA, and they're called by the Bank of England tough legacy contracts. We don't have enough time here to talk about tough legacy contracts, but this is still an unresolved issue, and the Bank of England and the FCA have suggested some solutions, as have the regulatory authorities throughout the world, but none of these have been bedded down. And almost certainly, if these aren't resolved, it will lead to disputes and it will lead to litigation, and then it'll firmly sit on Toby's desk in order to help to resolve the problems at that stage. But as I said at the beginning, agreements have fallback clauses. We think something like a third of agreements don't have any fallback clauses. But those that do will need to refer to them when LIBOR disappears at the end of 2021. I've written down here 2 of the most popular fallback clauses. The first is called the historic screen rate. Now, what that says is that if LIBOR is not published, as it won't be in January 2022, then simply use the last LIBOR. Well, you can see that if LIBOR is then never published, you will always use the last LIBOR, and it turns a variable rate loan effectively into a fixed rate loan. That can't be right, and either the lender or the borrower will benefit depending upon the market circumstances at that time. The second fallback clause is the cost of funds. This is perhaps even more problematic because some believe it will work. The difficulty with the cost of funds is that the lender has to calculate it, and obviously calculate it honestly, correctly, and accurately. But a bank's balance sheet, the lender's balance sheet, is extremely complicated. And to calculate the cost of funds accurately is extremely difficult. And for some, I would go even further and say near impossible. The second issue is that for a bank, the cost of funds is likely to be substantially below LIBOR. Now, I've done some calculations and they've been published, and Rob said that he would send those to you later, so I won't dwell on it. But if the bank's cost of funds is substantially below LIBOR, then you can see that the interest rate, the total interest rate on the loan, will fall dramatically for the benefit of the borrower to the detriment of the lender. The second problem with the cost of funds is that it's a commercially sensitive number. I don't know any banks that would want to reveal it. So that is problematic, and I dare say that many will want to avoid it. In terms of loans, the final loan I'll talk about are the fixed rate loans. Now, many people imagine because it's fixed rate, there's no LIBOR involved. Unfortunately, that's not quite correct, because fixed rate loans typically, if they are repaid early, attract a fee for repayment, a break cost, if you like. That break cost is calculated in relation to the LIBOR swap curve. But how will that break cost be calculated if there is no LIBOR swap curve? Is it the case that a break cost is not payable at all? if LIBOR is not there. Now, that's obviously a legal question and one for Rob and Toby to grapple with. But if that is the case, and given that interest rates have fallen so much over the recent period, the lender in the fixed rate loan will likely lose a substantial amount of fee, and the borrower will benefit and should immediately refinance from a high rate loan to a lower rate loan. Finally, I'll speak a little bit about swaps. Swaps, you know, are typically fixed for floating, so one party pays the fixed rate, another party pays the variable rate. Now, as I said before, interest rates have fallen dramatically. So imagine you entered into this swap where you were paying 5% fixed and receiving LIBOR. The current swap rate is, let's say, 2%. So if you were able to cancel the old swap and enter into a new swap at 2%, you'd save yourself 3% per annum. Of course, you can't do that under normal circumstances because there'd be a cost to pay to your counterparty equivalent to the 3% difference over the period of the remaining swap. But where LIBOR doesn't exist, the payer of the fixed rate could argue that it can no longer fulfill the agreement. And under those circumstances, the contract is said to be frustrated and the contract is then cancelled and a break cost is not payable. Again, this is an area of law that's extremely complicated and really one for the lawyers and not me. But it is for me to point out that this could involve a substantial amount of transfer of value from the payer of the fixed rate to the receiver of the fixed rate. So frustration and swaps are one to watch. ISDA has produced some fallback clauses that they're asking people to sign up to, and it's a question of debate whether people should sign it or not. And again, something that we can work on if needed. That's all really that I wanted to say about LIBOR. I know it's a very big topic, but given the time limitations, I'll stop there, Rob.
Thanks very much, Hanif. Yeah, there certainly are a lot of issues for us to ponder. Perhaps before I pass the baton to Otsuka-san, you mentioned the tough legacy contracts during your presentation. Are there particular classes of contracts that would fall within that banner, or does it really depend on the contract terms itself?
Yeah, no, there are some clear categories. The first is, for example, Islamic financing. It just doesn't lend itself to a backward-looking rate. It has to have a forward-looking rate. Invoice discounting. All of those structured products, and they're very, very popular in Asia, which involve what we call non-linear derivatives. So not straightforward swaps, but even perhaps caps and other geared products. They absolutely have to have a forward-looking rate. The equations, the terms of the contract simply do not work with a backward-looking rate. And because each of those contracts is bespoke, they will, I think, present a huge issue and a lot of problems to resolve, and will take time. So therefore, they need to be looked at quite early on. A second category of tough legacy contracts are those contracts that involve people like you and me, the retail sector. The Bank of England and the FCA think that backward-looking rates are too complicated for people like us, and therefore we need to be taken care of extremely well. And they don't think that a LIBOR, for example, should go to SONIA. And the third category is to do with connected contracts. So imagine you've got a loan agreement which can transfer from LIBOR to the risk-free rate. But associated with that loan agreement is a swap agreement. And let's say the structure of that swap agreement falls into the tough legacy contract. It cannot take a backward-looking rate. Now, one analysis says, well, the swap is a problem, but the loan is not. The real analysis is that because the two are connected, together they are a problem. So all institutions need to be really aware of this. It is not a question of separating out contracts individually into tough legacy and non-tough legacy, but rather to also see which ones are connected. And if they are connected, then they're all tough legacy.
Thank you, Hanif. That's very helpful. And I see Otsuka-san doing a lot of nodding there, no doubt in agreement with you. So coming to you, Otsuka-san, perhaps you could give us the perspective from Japan.
Okay, hi everyone, and today I'd like to focus on the viewpoint of regulators and policymakers rather than respective private institutions. Now I would like to share my slides on your screen. I hope now all of you can see my shared screen, so let me begin. As the basic concept of LIBOR and the need for a transition have been already explained by Hanif, now I want to overview the policy reactions by JFSA, Financial Services Agency, an integrated regulator of financial services in Japan, and also Bank of Japan. I will focus on transition of Japanese yen LIBOR rather than the benchmarks for other currencies, as I heard many of today's participants are Japanese companies. This is what I will explain today. First, I will briefly overview the survey result on the use of LIBOR, which was conducted jointly by JFSA and Bank of Japan last year, and then highlight expectation of Japanese regulators and the timeline toward the end of 2021. Finally, I will iterate the core message from regulators to financial institutions and other types of business which are preparing for the transition. I would like to begin with the survey result. JFSA and BOJ, Bank of Japan, conducted a survey on financial institutions' preparedness for the LIBOR transition in the fourth quarter of 2019, and the result was published in March this year. The survey was conducted with approx 280 Japanese financial institutions, including banks, securities companies, and insurance companies. Let's start with quantitative information. In the aggregate of the 5 currencies, US dollar, Japanese yen, euro, Great Sterling, and Swiss franc, the amounts outstanding of contracts referring LIBOR were 164 trillion yen of assets, such as loan, and 35 trillion yen of liabilities, such as deposit and bonds, and also 6,300 trillion yen of notional amounts of derivatives. You can also see that the volume of derivatives was the largest in terms of the number of contracts. Among all the contracts, 60% of assets and 50% of liabilities, and also 50% of the derivatives will mature beyond end 2021, which require actions by institutions to reduce risks stemming from the discontinuation of LIBOR. The reason why the exposure of Japanese yen LIBOR is smaller than that of US dollar LIBOR is that many Japanese yen denominated transactions refer to TIBOR, not LIBOR. Looking at the contract holders, most of the contracts were held by banks, in particular major banks such as 3 mega banks. However, for derivatives contracts, securities companies had the largest proportion with 65%, followed by banks with about 35%. Although small in the amount outstanding, insurance companies also held around 10,000 contracts as liabilities. This slide shows identification of LIBOR-related contracts and business operations by sector. As you can see in the left, almost all the entities had either developed a framework that can continuously track the volume of contracts referring LIBOR, or recognized the approximate volume of such contracts and transactions. In the right, about 85% of the entities had identified or roughly identified business operations that will be affected by the LIBOR transition. This is a very good progress, I guess. However, preparedness of financial institutions in Japan was still in the course of development. That was found in this survey. This table shows the progress of preparation by each sector. In the top line, you can see the number 1 to 4, 1 and 2 in the same cell, and 3 and 4. The 1 means action completed. 2 means action almost completed. 3 means action in process, and 4, action not yet started. The difference in color shows distribution of firms to each number, which means each stage of preparedness. Dark color, dark red, indicates there were many firms compared to the other segments. You can see most of the firms were not yet plotted to 1 or 2. While many firms had started IT system development, most of firms were yet to wrestle with review or amendments of the contract formats, nor started communication with clients. This is a survey conducted in 2019, so I hope many firms have taken major steps forward already, but the survey results shows there might remain a lot of works to do by the end of 2021. I think it echoes with the explanation at the beginning of this webinar, and the poll result, which you have participated, concurs with our understanding and observation last year. Second, I would like to go to the expectation of Japanese regulators. The solution to the LIBOR transition appears to be simple: to change the reference rate or to insert the fallback clause where the contract's due date is set beyond the end of 2021. However, the process of doing so requires deliberation and consent of parties to the instruments. It is not desirable for firms to wait until the last minute to tackle the LIBOR. Negotiation needs understanding of both sides of parties, of course, and further, there are tough legacy contracts, which is explained by Hanif, that needs bespoke consideration and negotiation. Non-standardized contracts needs more time and effort compared to standardized type products. Moreover, the cost of adoption may be much higher if you have issued corporate bonds referring to LIBOR. If a company decides to hold the bondholders meeting to change the reference rate or to incorporate a fallback clause, the length of time to complete all necessary procedure for the transition will increase. In principle, regulatory authorities cannot intervene private contracts. Therefore, it is the responsibility of firms to understand and take actions against LIBOR transition. So this slide, you can see the Dear CEO letter, which was sent by authorities in Japan. It is strongly recommended to complete required process sufficiently before the cessation of LIBOR. From this point of view, this letter, the Dear CEO letter, was sent in June 2020, this year. It was a letter requiring certain actions by financial institutions. Required actions are categorized into 4 areas. First, transition plan. Second, customer services. 3, IT systems. And lastly, operation. The transition plan includes transition or fallback for products referring LIBOR and appropriate actions taken by the board of directors. I would like to emphasize the strong commitment of executive class is the key for successful transition for all firms. In September, JFSA also recommended sign up to ISDA protocol, the protocol made by ISDA as an internationally recognized standardized fallback clause for derivative contracts. Although the ISDA protocol is applicable only to the contracts based on ISDA definitions, sign up to this protocol is an efficient and effective measure to prepare for the cessation of LIBOR. JFSA also highlighted the importance of IT system and operation of financial institutions that can accommodate calculation of backward-looking rate calculation with yes, that is required in referring to risk-free rates. Next, I would like to explain the expected timeline for Japanese yen LIBOR transition. Respective regulatory authorities have their own timeframes toward the end of 2021. So Bank of England had set its own timeline, and also Japanese regulators have their own timeline. When LIBOR will be permanently terminated, we have to be in a very good trajectory to shift toward other referencing rate. So this slide summarizes Japan's roadmap to prepare for the discontinuation. Now I would like to highlight two major events that await in next year. First, JFSA and BOJ will conduct the second survey on the use of LIBOR in the first quarter of 2021. The survey sets its base point at the end of 2020, and the regulators look forward to see the progress from the first survey. Second, lenders should offer non-Japanese yen LIBOR alternatives for new loans after second quarter of 2021. This will be a timing when all market participants have to be well prepared to leave away from Japanese yen LIBOR as a reference rate for loan and bond products. The regulators expect the number and volume of these products will reduce significantly toward the end of next year. So I would like to briefly conclude my major points. An important point I want to emphasize here is that the LIBOR transition is a pressing issue for all firms and not limited to financial institutions. Reportedly, not many non-financial corporations are fully aware of the importance of this LIBOR issue, hence not very well prepared. While financial institutions are expected to take, they have to concur with client firms for a smooth transition. I therefore hope all participants to today's webinar will take appropriate steps in line with the roadmap set by the authorities. I think national working groups of respective jurisdictions and international standard setting bodies such as ISDA have published reliable reference and sample clauses that many market participants can rely on. But it is up to private institutions, not regulators, who can take appropriate action toward the end of 2021. There, I believe legal and accounting professionals will play a pivotal role in many circumstances for a smooth transition as a whole and to avoid anticipatable repercussions. I will stop here and would like to pass the microphone. Thank you very much.
Otsuka-san, I wonder if you can ask a question as a follow-on to one of the comments you made. You spoke about bonds requiring amendment, and in order to do that, it'll be time-consuming because bondholders have to approve any change. To what extent are the regulators in Japan worried that bondholders will not agree? And what happens if bondholders don't agree to a change?
Yes, to that question, I would answer that regulators in Japan cannot intervene private contracts. So it is, as I said, the responsibility of private firms to amend or negotiate with its counterparty. So of course, we are very attentively monitoring the situation, but the last mile should be fulfilled by private firms. Otherwise, it is not probably our power that can change with a compulsory action that can be imposed to financial institutions. So just simply put, I really expect all private firms is well prepared to complete the negotiation with counterparties.
Well, thank you very much, Otsuka-san. That was very insightful and helpful. I think it's quite clear from what we've heard so far that there is quite a lot of work to be done, and actually not very much time to do it in. So with that in mind, Toby, if I could come to you to possibly outline some steps that should be being taken now, and what we're all worried about, the risks if steps aren't taken and we end up with contracts still referring to LIBOR at the end of 2021.
Yes, thank you. First of all, thank you to my colleagues. I hope the attendees have found their presentations helpful and stimulating. I want to ask the participants to think widely across their businesses about the impact of the transition away from LIBOR to alternative reference rates. Think about what you currently have and think about where you want to end up. That's the focus for the section that I will now turn to. With an eye to the time, I'd like to complete what I have to say and leave some time for questions. But what I would like to start with, therefore, is what do you currently have? Systems need to be put in place. Assessments need to be made. You need to identify and understand your current LIBOR referencing contracts. Do they have fallbacks? What fallbacks do they have? Do those fallbacks work? What happens if they don't work? Moving to the future, work out the comparative economics between what you currently have and where you want to end up. Hanif mentioned earlier the gap and talked about the extra spread. There'll need to be modelling done to understand your current position contractually and the future position that you may wish to negotiate. The message that we will be pushing throughout, and my colleagues have already said these things, but we will want to understand what you have and to review and renegotiate and rewrite these contracts. What's happened to date? Well, we've heard, and the audience no doubt will be well aware of the various regulatory statements around the world, but the time was called by Andrew Bailey on LIBOR in 2017, following a torrid time for the benchmark. And dear CEO letters have been sent by the FCA, as well as Mr. Otsuka has outlined, in Japan. In this country and in Japan, there is great pressure for participants to transition away from LIBOR and for firms to recognise their responsibilities to contribute to an effective transition. I'd like to quote, if I may, Randall Quarles, the Federal Reserve's Vice Chairman for Supervision in the US, because what he has to say, I think, is key to an appreciation of the reasons why participants need to act now. He said a few weeks ago, there are many different interests with respect to the LIBOR transition. There are some who wish it didn't happen, and there are others who are looking for the profit opportunities that there will be in the transition. We'll come back to that, because that is, in my view, a real impetus on all participants to understand their present position and to understand the position they may wish to move to. Mr. Quarles went on to say that he wanted everybody to complete the last sprint to the end of 2021. As my colleagues have also mentioned, there is the ISDA fallback protocol, and that may be useful in certain markets. It's time to do something is the basic message. What I want to do, therefore, is help you understand what you currently have. And I'm going to do some, I'm going to screen share if I can, and then make some comments about the sample wordings that I have on my screen. If I can first share. So I hope that that's now visible. Before I review these wordings with you, just a few words about the kinds of things that we find in contracts. Why am I asking you to look at this issue at all? Well, I'm a lawyer. If you come to me, I'm going to say, show me your contract. That's where lawyers will turn first. as Mr. Ozkaz explained, I think the figures were 60% of assets, 50% of liabilities, and 50% of derivatives in the survey that was conducted in Japan are expected to mature beyond the end of 2021. This may leave many contracts unfit for their purpose, as I hope some of these examples may help to explain. As Mr. Ozka also mentioned, negotiation needs an understanding. Both sides need to prepare. There are financial incentives, both on the lender side and the borrower side, to understand what you currently have. And when I say what you currently have, I'm talking about your contracts. If you're going to agree, for example, fallbacks, you need to understand what those fallbacks are. In the cleared market, there is great assistance to be derived from the work of the task forces and the regulators around the world, and from ISDA, for example. In the bilateral market, there is work to do, but there is help. My understanding is that the Japan Banking Association, Zenginkyo, has published sample fallback clauses in March this year. And the cross-industry committee on yen rate benchmarks has recommended a waterfall structure. So there is help, but in bilateral contracts and certainly in the tough legacy world, as my colleagues have contributed so far, there is a need to assess what you have in the contracts. And then you want to compare that to what is out there. These contracts contain a range of fallbacks, as Hanif has explained. Do they work? Well, you have to look through them to see what you have. And even when you have what you think is a standard form clause, it may still not work. We'll come on to look at example 3 in a moment, but just looking at this first example, typically you have a definition of screen rate. It goes on in red at the end. If this page or service is not available, that is LIBOR 01 or LIBOR 02 of the Reuters screen in this example, the agent may specify another page or service displaying the relevant rate. Well, what is the relevant rate? It will not exist, and therefore there is no meaningful alternative in this definition. Interest is calculated with margin and LIBOR. Changes, absence of quotations, another typical clause we have here. And this one says, if the base reference bank does not supply the quotation, then the LIBOR will be determined based on the other reference bank contributions. But of course, there is no LIBOR for those other banks to supply a quotation against. Well, if not, it'll be determined here on the basis of quotations remaining alternative reference banks. There are problems with that. Hanif has outlined some of those problems, and I'll come back to them. This is a typical clause, and in this example 1, this is the only fallback. You will enter into negotiations. As Mr. Otsukaze explained, in Japan and in many parts of the world, certainly under English law, it is the responsibility of the contract counterparties to resolve any disputes between them. And if not, then the courts will look at the issue. I'm going to mention in a moment whether you should rely on legislatures and regulators stepping in to help. And even in the case of tough legacy contracts, my view is that this is a risk and you should not rely on them stepping in to help. On the contrary, you should take active steps now to read and understand your contracts and to negotiate to a satisfactory changed position. So example 2, again, definition of LIBOR. If there's no screen rate, then in this example, the arithmetic mean of the rates supplied by the reference banks to leading banks in the London interbank market for the offering of deposits in the currency of that loan and for a period comparable. Again, I think it'll be clear from the comments of my colleagues, when LIBOR is no longer being quoted, then it will be difficult to deal with this definition. There will be no comparable period, arguably, in a risk-free rate. And unless somebody produces an alternative to LIBOR, for example, Ameribor, then these things may be put to use, but that's not what this contract envisages. And this contract may therefore simply not work. We come down in this example again to quotations of reference banks, and we have a percentage. This is clause 10.22, percentage rate per annum, the cost to that lender of funding its participation in that loan from whatever source it may reasonably select. Now this is the cost of funds fallback. If you see that, that's a cost of funds fallback, and I'll come on to comment about those. The problem here is that LIBOR was calculated using panel bank submissions, disregarding the top and bottom 25% and taking the arithmetic mean of the remainder. It didn't depend on actual transactions. In the example that we're going to come on to, we'll see the problem that arises. But here, what if none or only one of the reference banks supplies a rate to determine LIBOR? Well, then it's a market disruption event. Enter negotiations with a view to agreeing a substitute basis. That's what's provided in this example. And that again is not good enough, because under English law, this is an ineffective agreement to agree, ineffective other than in encouraging negotiation. But what if you fail at the end of that negotiation? So here we get to the third example. I'm conscious that I may be rushing, but let me just slowly take you through some of the points here again. So LIBOR, screen rate, or as determined pursuant to clause 10.1, unavailability of screen rate. And in this contract, we have a provision that says if the rate is less than 0, LIBOR will be deemed to be 0. The screen rate is then defined, and again, the lack of service provision, another rate, another page displaying the relevant rate. Well, that won't work. Interpolated screen rate, there's another attempt to deal with problems, but look, they depend on screen rate again for this interpolated screen rate alternative. Reference bank rate, the rate at which the relevant reference bank could borrow for the relevant period, that won't work. So we're looking at clauses in contracts. These are real contracts, excerpts from them, relatively recent contracts, in fact. And they all have problems. We go on in this contract to the unavailability of a screen rate, and this paragraph sends you into cost of funds as the fallback. 10.3 market disruption. This is the cost of funding from whatever source it may reasonably select. If it would be in excess of LIBOR, then clause 10.4 shall apply. 10.4, we see here, if the lender's rate is less than LIBOR, well, that's contradicting the clause 10.3, which this refers to. And then this clause, if a lender does not supply a quotation, the cost to the lender of funding its participation for that loan for that interest period. So the cost of funds fallback shall be deemed to be LIBOR. Well, this is an example of a complex provision which appears to be a cost of funds provision, but has internal inconsistencies which make it very difficult to apply. So again, it's really a matter of looking specifically at what you have in order to understand how to deal with it. Now, the cost of funds fallback, Hanif has explained some of the problems. Mori, Hamada, Matsumoto, I know, have been involved in releasing sample fallback provisions for bilateral loans. And that is something which is of assistance and ought to be considered in context of the contracts which you may have. But the economics of replacement benchmarks must be borne in mind. Value transfer will occur, and regulating the transfer of value is really what your negotiation must focus on. Otherwise, as Randall Qualls has pointed out, somebody will make a profit. There will be a loser and a winner in many of these situations. And it is a question of minimizing transfer of value away from your position into the hands of your counterparty by negotiating the spread adjustment in such a way that you are satisfied and you can compromise your position on a basis which you're happy with. So lots has been said about cost of funds. Hanif has also commented on some of the problems with it. But it was never expected to replace LIBOR. It was a temporary replacement, and lots of these fallbacks were originally designed as temporary fallbacks. There are technical problems. Often the fallback requires an annualized rate, which is not available once LIBOR, not available in the same way, at least once LIBOR has gone. And how do you cost the lender's participation? This is really open to great uncertainty. There is a discretion which is likely to be exercised by the lender, but who is your lender? And it matters because it's that lender's cost of funds. But as Hanif has already said, nobody will release their cost of funds information voluntarily. So there are, I think, quite a number of issues. Let me stop screen sharing. The issues that this gives rise to are manifold, but the areas to look are not just your loans, bonds and derivatives. There are also intragroup accounts, for example. You will have to look and identify where your LIBOR linking occurs. Work out whether you have contracts maturing beyond the end of 2021. Look at the contract terms and conditions. Renegotiate. Replacements, as I've said, in the cleared market will be easier. Replacements in the bilateral market will probably need detailed help, not just from legal input. You will need to understand, of course, where your governing law contract is and which law and jurisdiction clauses you have in order to determine which lawyers to use. There will then be a negotiation around the risk and credit and liquidity premium issues. I'm running out of time, so let me just quickly comment on the English legal backstop. If you fail to negotiate, you'll be thrown into court, and courts will have to determine these matters based on evidence, and really it's one against one in court. There is a loser and a winner, and in English law there is much uncertainty as to the outcome which can be expected once two rival expert witnesses give their evidence, which is why we strongly urge negotiation by comparing what you currently have to what you will have. I'd like to leave a little bit of time for questions, and so I think I'll leave it there. But the aim should be to agree explicit fallback language and obtain fair value. Let me leave it there and see if the audience has questions which we can deal with.
Thank you very much, Toby. Yes, sorry, we are running a bit long, but whilst the audience has a few minutes to consider what questions they may have, I'd also like to just put up one final poll. Stop sharing results, see if I can do it. Sorry, I've technical failure there. I'm not Here we go, polling 2. If there are any questions on LIBOR or indeed any related issues, we'd love to hear from you. We have been able to cover off a couple of questions that were raised earlier, but if there are any more, we would of course welcome them. Meanwhile, the polling is progressing. Just a few more votes to come in. We seem to be stuck at 66%, but I'll call time there. Just shared the results. So it looks like it's been a positive response, that people are, by and large, now going to be taking more steps, because this is quite an important thing to do, to rectify or identify and rectify any issues relating to LIBOR. It is quite tempting in this day and age to focus very much on the short term, of course, given the global pandemic and here in the UK issues such as Brexit. But it is important that you all take steps now, or if you are private practice lawyers, advise your clients to take steps now to try and address the position. Otsuka-san, perhaps if we don't appear to have any questions, so perhaps if I could just hand over to you for a few last minute words before I close the webinar.
First of all, thank you for inviting me to this session. And actually, the regulators, as I said, attentively monitoring the situation, and we strongly hope all the business entities can be very much well prepared by the end of 2021. So I'm honored to close this kind of a briefing session today by hoping that you have better understanding of what the LIBOR transition is and what actions are required in the coming months. Thank you.
Thank you very much, Otsuka-san. And on my behalf, thank you very much to the panel for your helpful and insightful comments. And on behalf of the panel, thank you very much to you as the audience for attending. And if you do have any follow-up questions for particularly either Toby or Hanif, we've shared their contact details on the screen. And I've also included links to the specific pages of the Japan Financial Services Authority and the Bank of Japan, which were referenced in Otsuka-san's presentation, should you think it helpful to dig out further details on those.
Thank you.
And with that, I'd like to say thank you very much all, and I will close the webinar. Thank you all.